pointing to tops in the bond market and the S&P now. And the real question is, and this is to me the critical point, what happens if the markets break, meaning the S&P and the bond market? Those markets break because they peaked out, according to the cycle, and then money starts flowing to something that people want and crave as protection. And that means gold and silver, and they've just bottomed. So there's lots of upside available in the gold and silver market, and I see very little upside in the bond or stock market.
Our back up the truck moment is here. Just $10,000 into Keith Neumeyer's last 2 deals could have been turned into $1.8 million for investors. Now he's going all in with a gold acquisition company, a precious metal mineral bank. We consider this a gold portfolio must. Learn more at futuremoneytrends.com/fortune.
Hello everyone, and welcome into CrushTheStreet.com. I am joined today with a returning guest, Gary Christenson of DeviantInvestor.com. He is the Deviant Investor and author of multiple books. In our last interview, we actually covered some details of gold in Fort Knox, as his latest book is titled Fort Knox Down, a story about Fort Knox, the gold, and whether there's gold even there, and some different scenarios related to that. And it was a great discussion, timeless discussion, and I recommend everyone to go back and listen to that. But today we're going to have a discussion with Gary about precious metals, the current environment, and just someone who's on top of the economy. So Gary, thanks for joining me today.
Well, thank you very much.
Gary, let's start off with the economy and gold. We know that ISM non-manufacturing came out today, and it actually was negative. It was lower than expected. And I want to get your thoughts here on gold, the beneficiary of this uncertainty in the economy. We know the U.S. talks gold down, the elites, the gold is not a big deal, but in the East, they are hoarding gold. So what are your thoughts on going into the fall here in 2016 on the economy and gold?
Well, I agree with all of that. Things are strange in the world today. Jim Rickards has made a large production. He's got a very large internet presence about the decline of the dollar and the rise of the special drawing rights from the IMF. And all of that being a September thing, the rebalancing of the special drawing rights. It's difficult for a lot of people to comprehend that because we don't deal with special drawing rights every day. We deal with dollars. But he's in a rarefied atmosphere where he believes that's very important. That's just one minor point. A second point would be Jeff Berwick has been talking about and he's on the Dollar Vigilante. He's been talking about the Shemitah year and the 7th of the 7, and that would be this year. He's looking for a massive massive reset here in the September-October period of time. And then, of course, we've got an American election with 2 rather polarizing candidates, and we have 13 trillion, more or less, of negative interest rates for sovereign debt around the world. And how can you have negative interest rates in a sensible, sane economy? In effect, what you're doing is saying, I'm happy to give my money to sovereign governments and expect to get less in return from it. And what reasonable person does that unless there's some overriding pressure that pushes you in that direction? Like, for instance, I'm going to buy a bond now and sell it to somebody else for even more in 6 months. That somebody else might be a central bank who's trying to purchase those bonds. In other words, it's gotten rather crazy. But all of those characteristics that I've described, the rise of the SDR, the fall of the dollar, negative interest rates, central banks increasingly enforcing their presence into the markets, are all gold positive in the long run, and probably even in the short run. In fact, I think I see gold up 20-some bucks today, silver up like 60 cents today. These are big moves, and these are big moves because there's massive flows of capital that seem to have reversed or starting to reverse out of dollars, out of stock markets, and more towards precious metals. That would be my initial reaction.
Yeah, it's interesting, in regards to gold here. Number one, the dollar has actually not gone down that much. I mean, we're still kind of in that 95 on the dollar index, and gold is still doing pretty good. It's performing well. And we know that Asian countries are hoarding gold while Western markets are suppressing their prices. What are your thoughts on this? Asian countries hoarding gold and Western markets suppressing the gold price?
Well, I would say the Asian countries are doing the sensible thing. When you look at, in my opinion, financial system that is living on borrowed time and living on massive amounts of borrowed money, we're looking at something like 230 trillion of debt in the world. Wouldn't it make sense when you acknowledge that A, that debt can never be repaid, or at least it can never be repaid in anything close to current dollars, euros, yen, pounds, etc., and B, something that's survived for 5,000 years as a store of value, gold, wouldn't it make sense to shift from one to another, from digital currencies and debt-based currencies to gold and silver, which is what Asia, Russia, China, India have done? And that seems to me immensely sensible. Now, why the Western countries are repressing the price of gold and silver and then trying to build up more paper currencies and more debt, that's difficult to discuss, but it just seems to me like that's a maintain out of desperation a failing system.
And I guess to add to your point there, one thing Jim Rickards points out is that this rush to include China in the SDR should be seen as a global monetary elites getting their ducks in a row before the next panic comes to destroy, people's portfolios. And, I'm curious, what are your thoughts on this? Is that part of China just positioning themselves in, the shift away from the Western powers to Eastern powers?
Well, yes, I think China's a very long-thinking country, and their plans are oriented toward increasing their economic power. And every bit of increase that they are trying to engineer, that they're trying to create, ultimately means weakening and diminishing power for the Western countries, more particularly the United States. And one symbol of that is increasing gold in China, and they clearly have a great deal more gold than they admit to having. And why should they tell the truth? They have an agenda. They're going to follow their agenda. They're going to do what's good for them. And we're not telling the truth about how much gold we have. When I say we, I'm talking about Western countries, specifically England, Switzerland, and the United States. So why should China? But the point is that the shift in power goes along with the shift in gold, and we can see that. Now, another factor that's involved in this is, we can look at very long-term cycles, and, I understand that people are suspicious of cycles, and I understand that people believe that, and with good reason, they believe that central banks are overwhelming current and short-term systems, whether it's buying of massive amounts of bonds in Europe or in Japan, or the Federal Reserve cranking up and propping up the bond market and the stock market here in the United States. I understand that short-term cycles can be easily distorted, but I believe, and I perhaps I'm wrong on this, but I believe that long-term cycles are very difficult to distort by central banks and other forces. And if you look at long-term cycles in the bond market and in the S&P and in silver, you see something that's very interesting. You see a 7 2/3 year cycle peak, and there's a purpose to all of this roundabout discussion. There's a 7 2/3 year cycle peak in the bond market that's roughly now, I have it pegged as July of 2016. And then going back, you can see that peaks go back in December of 08, March of 01, October of 93, and April of 86. And you find peaks that are roughly consistent with that cycle in the bond market. Then you do the same thing on the S&P, and you find that you get a 7 to 8 year cycle peak going back back to 1987. And then you look at the silver, and you find bottoms at roughly the same time. You find bottoms in December 15 and January 16. You find a bottom in June of 12. You find a major bottom in November of 08. These cycles are big, long-term, roughly 7-8 year cycles, and they're pointing to bottoms in precious metals a few months ago, like December, January. They're pointing to tops in the bond market and the S&P now. And the real question is, and this is to me the critical point, what happens if the markets break, meaning the S&P and the bond market? Those markets break because they peaked out, according to the cycle, and then money starts flowing to something that people want and crave as protection. And that means gold and silver, and they've just bottomed. So there's lots of upside available in the gold and silver market, and I see very little upside in the bond or stock market.
Yeah, going back and talking about the stock market here, it would appear that all the highs, all the all-time highs that we're seeing is coming directly from the fact that central banks are not going to raise interest rates. And they raised interest rates indicating that things were going to get tighter in December 2015. And ever since then, they've been backing off of it and haven't done so, and just signaling to the market that they're not going to. And I'm wondering, would you agree with why we are seeing all-time highs is simply the Fed just backing off their language as to raising interest rates and following through with what they said they were going to do?
As well, yes, as well as other central banks purchasing securities. So we've known that they announced that the Swiss central bank and the Norwegian central bank printed up their own currencies and then bought gold stocks. And we know that the Japanese central bank is buying not only Japanese stocks but American stocks. And I would presume that the Federal Reserve is buying American stocks, all in the interest of keeping the stock market supported and levitated prior to the upcoming election. Certainly the interest rates, keeping the interest rates low is an important thing. And I believe that on the underneath side, also aggressive support of the stock market is happening. There's a third thing to consider here, and that is we keep talking about 8 years of low interest rates or 8 years of zero interest rate, and then we make a token quarter point rise in the interest rates back in December, and then we say, but we're not so sure the market can sustain another quarter point rise. It might trash the market. It might absolutely crash the stock market. How is it that we have a healthy system if a quarter point rise in interest rates could crash the stock market? To me, that indicates two things. The markets are not healthy, and that we are sustaining these stock markets on fumes, and that it's just all about trying to sell to another person at a higher rate because we trust the central markets or the central banks will always bail us out. And history tells us that doesn't work forever. That works until things correct, and then you get a really nasty correction like in 2007, 2008, or in 2000, 2001. I think we're approaching a nasty correction.
Gary, remind the audience, and even myself, what it's like for the central banks to actually be able to move interest rates around. Historically, what type of moves have we seen, and were they this dramatic to what the stock market and how the stock market would react?
Well, I'm not sure I understand your question, but let me take a stab at it. Typically, 10-year rates are somewhere around 7 to 8%. The long bond is always yielding somewhere in that neighborhood. You can run, like Greenspan dropped in the early 2000s. He dropped the short-term rates from 6% down to a very small 1% or something. Those are typical kind of central bank actions, not the actions of, say, the Federal Reserve keeping interest rates at effectively zero for 8 years, or the Japanese and the Swiss and the European central banks forcing interest rates into negative territory. I saw something that said the Swiss rates were negative out to 40-some years. I mean, how insane is that? Those are not normal things. And if you would talk to an economics professor or a central banker 10 years ago, I think they'd tell you that it's flat out impossible. And yet here we are, we have it. And if we have crazy things happening, there's probably a tremendous amount of stress in the system. And if there's that much stress in the system, we're just waiting for the snowflake that Jim Rickards talks about that will cause the avalanche that will cause a crash. Now, does that crash occur this week, this month, next year, or 5 years? I don't know. I lean toward earlier rather than later, but why try to time it when the risk is pretty high trying to time it?
You know, one thing we do know is that lowering interest rates is a short-term boost to the economy. You know, car sales and real estate, I mean, different parts of the country, it's still kind of hot, I would say. And other areas are slowing down too. And really, we kind of saw that after Brexit, because we saw the 10-year bond, the yield just fall on that, and interest rates for the underlying economy got really cheap, and, you know, things got affordable. And I'm just wondering, how long can this debt leveraged, overexpanded economy continue to just survive off these ultra low interest rates before, you know, the last straw breaks the camel's back?
Well, you know, that's a really big, important question, and the answer to that is less than clear. You know, if you look at people like, and I think I quoted this in one of my articles, Paul Singer was said something pretty critical, sudden, intense market breakdown. You know, he's a pretty well-respected and bright guy, and he's talking about sudden, intense market breakdown. Bill Gross, managing some of the largest pool of money in the world, he's very concerned about what the central banks have done in manipulating the markets. Those suggest that the situation is ripe for a correction, or ripe for things to change, ripe for that last straw to actually break the camel's back. And then I go back to my long-term cycle. If you look at that long-term cycle, you say we're right at that point of peaking in the bond market and peaking in the stock market, and we're, say, 9 months after a bottom in the silver market. To me, those things all point to imminent.
It's quite the convergence of events. So let's talk about the opportunity in this, Gary, and just your contrarian investment strategies in this environment.
Well, you know, I have to agree with a lot of the things you said on your website about gold stocks, silver stocks, minerals and mining. You know, Keith Neumeyer and First Majestic and a bunch of others like that. Those seem to be the places to be right now. It doesn't, you know, just ask yourself, would you rather be in something that does real stuff like silver, or something that is hoping for a central bank to buy your negative yielding bond at a slightly higher rate than you put into it, knowing that if you hold that bond to maturity, say 10 years down the road, you'll be guaranteed to get a great deal less return on your money in a currency that they've guaranteed to devalue. Which makes more sense to the average person? It may not make sense in the rarefied levels of central bank purchases, but to you and me, where would you want to put your money? And I think you want to put your money into something that's more real, more likely to stay real, less susceptible to central bank intervention and manipulation, and that still keeps pointing back to gold and silver. If you want to look at it from a cycle point of view, you say, do you want to buy at the highs, bonds and stocks, or do you want to buy at the lows? I'd say silver and gold are near, just past their lows, and the same with silver and gold stocks. Look at what the XAU and the Gold Bugs index, the stock index, has done since last December. They've gone up substantially, and probably with massive upside still from here. Not so with the traditional stocks, say the S&P, and not so with bonds.
Yeah, I mean, I heard this was pointed out to me back in the 1980s, you know, where debt was and where debt is today. And debt's like 20 times bigger just here in the U.S., and, you know, the stock market, the overall stock market, the Dow Jones, S&P, is also up 20 times in about the same period. And it's directly connected with the amount of debt that we've taken on. And we know that that can only go on so long. And we know that the general stock market is dependent on that expansion of debt, and it's going to break. And the opportunity is going to be in real assets, real metals, and I couldn't agree with you more there. Gary, I want to thank you again for coming on the show. Please, if you have any closing words, closing thoughts, I'd love for you to share them now, and also let people know about your website and books.
Well, the website is deviantinvestor.com, and I publish articles. Everybody has to understand they're my opinions, and I'm largely not consistent with what Goldman Sachs would have to say. And if you find that difficult, then you shouldn't come to my website. But if you're a little tired of listening to what Goldman Sachs and the Federal Reserve has to say, then maybe you'll find something of value on my website. Otherwise, it just looks to me like take a look at what's real, take a look at what's not real, and it's hard to see pieces of paper that are guaranteed by your government and your central bank to be devalued as very real, whereas if you hold a 1 ounce silver eagle in your hand and realize that silver's been valuable for thousands of years and will continue to be valuable, it seems to me it's real easy to make an intelligent decision there. It's also hard to break out of the mold, the matrix that we all live in, where we think you have to have your money in digital accounts and dollars and brokerage firms and so forth. But if you break out of that, you probably will be rewarded.
Great closing thoughts there, Gary. Everybody, Gary Christenson of deviantinvestor.com. Please check out his books. Great information. Gary, thanks for coming on the show.
Well, thank you very much. Good day.